What are the most important fundamental drivers for gold today? And what does this mean for investors? Luke Gromen, president of Forest for the Trees, is here to discuss the macro factors behind investments. Luke, welcome to the show.
Thanks for having me on, David. It's great to be here.
You said to me offline, gold is a very political metal. What do you mean by that? And how would you evaluate the current political environment right now in relation to gold?
Absolutely. A lot of investors want to look at gold strictly on a supply demand, who's buying, who's selling, what's physical doing, what's paper. All of these things work together. But gold, by virtue of that high stock to flow ratio, by virtue of having been the reigning primary reserve asset of the world for 300 plus years prior to the U.S. Treasury bond taking that role after Nixon closed the gold window, it's a political metal because it competes with the U.S. Treasury bond as primary reserve asset. And so to the extent that gold does well, historically, that is a threat to the U.S. government being able to finance its deficits painlessly. And so there has been a need to manage the gold price, and that's not conspiracy theory. You can read any number of central bankers at the Bank of England, Greenspan at the Fed, the U.S. State Department wires and cables from the 70s. They are stating that to be the fact that the gold price needs to be managed. Paul Volcker. And so for 40, 50 years, we've seen this management of the gold price for political reasons. Now, some of those things I think were good as we're trying to win the Cold War. It's not helpful to have the dollar hyperinflating against gold. Since then, I think it's been more about trying to finance deficits, trying to keep this debt-based system from having bigger issues than it's had. When I say it's political, though, is ultimately we're now into this sort of paradoxical stage where historically gold rising in price was telling investors that something's wrong, that the existing system has a problem. We've allowed the debt to expand to be such a great amount, whether it's sovereign levels, corporate levels, muni levels, junk levels, consumer levels around the world, that the only way the system can avoid a real calamity is if interest rates stay negative, real interest rates stay negative and get increasingly negative, so that governments in particular can inflate their way out of this without causing a very big problem or a crisis. And so to the extent that gold is a barometer on what real interest rates are doing, there's a very tight correlation, inverse correlation between the price of gold and real interest rates. Historically, a rising price of gold is telling investors that governments are mismanaging the currency and to get out of sovereign debt and into gold. Paradoxically, they've extended this system for so long, they've allowed the debt to expand so much because they need increasingly negative real rates just to keep the wheels on the cart. Now a rising price of gold tells investors real rates are rising, the system's getting less solvent. A falling price of gold tells investors real rates are rising, the system is getting less solvent. And a rising price of gold tells investors real rates are falling, the system is getting more solvent. This is good for assets. And so we've reached this very interesting, like I said, paradoxical point in the long cycle where when you talk about politics, it's suddenly in policymakers' interest for the price of gold to rise steadily to signal to the markets that real interest rates are falling, that inflation is picking up, and that everything's okay. And so I think it's a really interesting sort of flip in the dynamics that a lot of people are used to regarding the lens they use to look at gold.
You're a macro guy. I love speaking macro with guests because, this is the fundamental cause of gold prices, and not just gold. We're going to be talking about Bitcoin and a bunch of other securities as well. So starting with gold, your outlook for 2021.
I think the outlook for gold for 2021 is really positive, is very bullish. I think that really for two reasons. I think number one, when you look at the U.S. Fiscal picture from a big picture perspective, we have, as a result of the COVID crisis, the U.S. fiscal position has really become not just unsustainable, which is what you hear from Janet Yellen and from Powell and other U.S. policymakers. And for them, it's always unsustainable, but we don't have to worry about it till tomorrow, till 2 years from now, till 5 years from now, et cetera. COVID made the U.S. fiscal situation unsustainable, and it made it acutely unsustainable. And what I mean by that is if you look at the U.S.'s big three expenditures, which are entitlements, defense, and interest expense / treasury spending, which is what stimulus is lumped into over the last year. You look at those big three, back in 2016, they were 86% of U.S. Treasury receipts. By 3Q18, they were 103% of U.S. Treasury receipts. And after COVID, they were 140% of U.S. Treasury tax receipts in the third quarter of 2020. And so what this tells you is they're having to borrow 40% of tax receipts just to pay the big three expenditures of the U.S. government. And so it really is this unsustainable situation where because that number is so big, you really can't raise taxes enough to pay for it, the difference, without hurting the economy and GDP. And so if you have GDP falling as a result of tax increases, you're actually making the situation worse, not better. You can't cut things enough because it's so big now without, again, hurting GDP, because the U.S. federal government overall is over 20% of U.S. GDP. And so they're really, the only outcome is what either helicopter money, modern monetary theory, whatever you want to call it, the Fed's going to have to basically grow their balance sheet enough to help finance these shortfalls. And so ultimately, that's a very bullish picture for gold. And it implies that we have significantly negative real interest rates are really a requirement for the U.S. government to keep the fiscal position together. And so that's structurally a very bullish outlook for gold. I think it's very good for gold.
Luke, I've heard people talk about monetary stimulus as a tailwind for gold, and I'm wondering why. Because let's talk about the entire history. Well, not the entire history, but let's just say the last 50 years. Has monetary stimulus always led to a growth of the balance sheet? Has that always led to increasing gold or rising gold prices, rather?
Yeah, no, particularly past 2000, post 2008, there has been a loose positive correlation to Fed balance sheet growth and what gold does. I think the tighter correlation are real interest rates, and the inverse correlation, which is the lower real interest rates go, nominal interest rates minus the rate of inflation. The lower real interest rates go, the better it has been for gold.
Okay, let's talk about the components of the real interest rate now. Starting with inflation. So in order for the real interest rate to be low or even negative, which is going to be conducive for gold, we need more or less a positive inflation rate. And so I wonder if we're going to get that this year, given everything that's already happened last year. Have we caught up in terms of economic growth?
I think the inflation rate is heavily dependent on A, what the government does in terms of stimulus, and B, what they do in stimulus amount, and B, what they spend it on, right? So if they do a bunch and if they spend it on the right things, then absolutely, I think we'll see more inflation relative to last year. I think the $2,000 or whatever it is, the $1,400 on top of the $600, that is, I think, a good step. You're handing money to people and they are going out and spending that money. You're handing money to people with a high marginal propensity to consume. And they're going to go spend it. And there'll be more dollars chasing fewer goods, particularly given you're still seeing fair degree of supply chain disruption around the world. You can see it in terms of boats off the coast of California. You can see it when my wife yesterday, where our dishwasher broke and she went to order it, and we can't get a dishwasher till late March. So we need to wait 2 months for a dishwasher in America, which is not something we're used to seeing. So more dollars chasing fewer goods, disrupted supply chains, I think, can drive some continued inflation.
I think that's an old Soviet joke, going back to the dishwasher story that you just told. A man, the Soviet Union goes to buy a car, and the dealership says, "Okay, we'll deliver it to you in 10 years." And the guy says, "Morning or night?" And the dealer says, "What difference does it make 10 years from now?" Because he says, "Well, the plumber's coming in the morning." So But it's happening now too. Right? You can't even get a dishwasher in 3 months. Why is that? Is there like a supply chain issue? Is like what's happening?
They're saying it's supply chain, and I don't know. I mean, we've seen a couple of headlines surrounding semiconductor supply chains. Obviously, as it relates to the auto sector, we've seen there was a substantial degree of disruption around COVID throughout much of the middle of last summer, but you'd think that'd be starting to normalize. I was reading articles yesterday talking about this backlog of boats sitting off the coast of California that are having difficulty unloading. And so some of it, I think, might be transportation equipment, pre-positioning type issues where, the boats and the containers and the trains are not where they all need to be relative to where the goods are. So I think there's a number of different things at work, but it just means that I'm washing dishes by hand for 2 months. So,
Okay. The other component of real interest rates, that's very interesting. We'll follow up on that. The other component of real interest rates is the nominal rate. Now, we've seen yields pick up, which is one of the reasons why gold has fallen. So can we expect a continuation of nominal rates to increase?
If you gun to my head, I think yes, because of the dynamics we talked about before, which is we're seeing the stimulus, we're not seeing the Fed do enough in terms of balance sheet growth relative to the amount of stimulus, and so ultimately you should see this crowding out, for lack of a better word, aspect of global dollar markets as a greater burden of financing the U.S. government's massive deficits falls on the shoulders of global dollar markets, sending dollar interest rates higher around the world. Now, that does weigh on gold, but it brings us, every day that happens, brings us closer to what I think is the huge structural positive for gold, which is there is an interest rate beyond which the U.S. government, the U.S. Fed is not going to let rates rise any further. And that is some sort of yield curve control where you really get into turbocharged growth of the Fed's balance sheet. You get into significant decreases in real interest rates. And that's where, when you say, hey, do you have a positive outlook for gold? That's why, because I don't think we're that far from that moment. Now that the 10-year treasury yield's over, whatever it is, 110 today, 115, wherever that number is, I don't know if the Fed comes in with yield curve control at 1.5%, or if it's 1.75, or if it's 2. I don't think it's 2.5 or 3. And so the closer we get to that level, whatever that level is, the closer we get to the Fed having to effectively cap that yield by growing their balance sheet at accelerating rates. And I think that's going to be, as we near that moment, and then once we go beyond that moment, I think that's going to be extremely positive for gold.
I've gotten some very bullish long-term calls for gold on our show from guests. I had one guest tell me $9,000 in a few years. Jim Rickard said $15,000 by 2025. Pierre Lassonde, $20,000 is not out of the question, he said, based on the Dow-Go ratio. I wonder what your thoughts are on these outlooks.
Those outlooks are all reasonable to me. One of the numbers I've looked at, and I think that Dow to gold ratio that Pierre cites is very relevant. One that I've looked at is, because the United States is a reserve currency issuer and has been for some time, I look at the foreign held U.S. treasuries as a percentage of the market value of U.S. official gold. And if we go back 50, 60, 70 years, that ratio was never below 40%. Never below 20% before 1989, when the USSR broke up. And it was usually in the 40% range. And as soon as the Berlin Wall came down, USSR broke up, that ratio, which effectively tells you how gold collateralized are the US's foreign debt obligations. Because we can always sort of, shaft our domestic audience easily enough, but you have to maintain your foreign obligations by sort of international rule. That gold collateralization of U.S. foreign obligations went from 20% in 1989 to 4%, 3% at the lows. Call it, I think, 2003, and it hit it there again in probably 2015. It's since bounced back to maybe 5, 6, 7% of foreign held treasuries outstanding. And so if you say, okay, if we just go back to the 20%, which was really the lows of the prior 50 years, that requires a 3 to 4x increase in the price of gold from here. So that gets you to that 6,000, 7,000 number. Now, when the U.S. has fiscal problems, the last time the dollar was really questioned was in 1980. And the market value of U.S. official gold as a percent of the foreign held treasuries outstanding went to 140%. And so 140% now would be about $40,000 per ounce. And that's really where you get to a gold bubble, right? Where what that was saying is basically the foreign held treasuries outstanding of the United States government were 140% collateralized by gold. Everyone that held a treasury could go turn them in for gold, and there would still be 40% of our gold left over. So that's when there's really a gold bubble. When all your sovereign debt is 140% gold backed, that's a gold bubble. But right now, we're nowhere close to that. Like I said, it's 6-7%. And, I think the right range is 20 to 40%. And if there start to be questions about the dollar and U.S. fiscal position, what
does 20% equate to in terms of a gold price?
$6,000 to $7,000.
Okay. So why aren't we seeing that kind of level today? What's holding it back? Well, both in terms of the gold price and the percentage that you talked about.
So historically, it's been one of the best management tools for gold's price has been the expansion of unallocated paper derivatives, effectively. So when you look at where the center of those is in London, you see not the expansion. Most people that buy gold don't end up buying gold, physical gold. They end up buying a claim on gold. And so if people want to buy gold, there's one of two things that can happen. Either the amount of unallocated paper leverage effectively on each physical ounce can expand, in which case the price won't rise, or the amount of physical demand can rise, and then the price will rise. And what we have seen institutionally, systemically, for really the last 30 plus years has generally been expansion in paper leverage instead of expansion in the price of gold. And so I think that's ultimately the issue. The question then becomes is when will that change? And that's really much more of a political question than it is a markets question at this point, as it's been for some time.